2025, stock markets, one word. Go.
It didn't move much.
Didn't move much? Really? Wait, I have something exactly for this one. 2025, stock markets, one word. Go.
25% tariffs?
Right. 25%? Wait, no. It got hiked again. 50%. And trade negotiations began. Tariffs, hikes, negotiations. That's one version of 2025. 2025, stock markets, one word. Go.
AI bubble?
AI bubble. Now, where did I put that AI thing? AI stocks hit all-time highs. Is AI the next dot-com bubble? You know what? Everyone remembers 2025 differently. Nothing happened, tariffs, AI bubble. But what was 2025 actually all about?
Pivotal as per expectations.
I would say consolidation.
I think one word for 2025 is going to be inflection.
I think if I have to sum it up in one word, it has to be inflection.
It had to be, it would be surprise.
Lot of uncertainty.
Kind of like a year of consolidation.
We spoke to 8 fund managers who collectively manage more than several lakh crore rupees. Now, I wanted to understand 2025, much like you. And what I realized was that these fund managers, they view 2025 in a way that you and I don't. A lot happened. Donald Trump took office and shot tariffs at many countries. The first shot, 10% tariff on all US imports and a 26% duty on Indian goods. We tried negotiating but didn't succeed. And on August 1st, a flat 25% tariff was imposed on most Indian exports to the US. And not even a month later, an additional 25% penalty was imposed on India's purchase of Russian oil, taking their total tariffs to 50%. And that's the highest imposed by the US.
I would say that we were expecting that there will be tariffs. So tariffs, India was not going to get away with it, right? And just like he mentioned that he's going, but if the tariffs were in tandem with what was there on the other competing partners of India, say for example, whether it is Vietnam, whether it is Bangladesh, for example, in case of textiles, then it's a level playing field and it wouldn't have mattered much. But the extra 25% which was imposed because of the fact that we were importing oil from Russia was totally a big surprise. Everyone was expecting, and as a portfolio manager, I was also expecting that the tariffs on India would be there, but it would be probably similar to what it would be there in our other competing partners. But the additional 25% which was imposed on India because the fact that we were importing oil from Russia really put us apart.
Factoring a lot of volatility. So let's say, just to give an example, if you are trying to move a very big container ship at the rate of change for a speedboat, you can easily maneuver a speedboat, but now you are trying to maneuver a container ship with the thought process of a speedboat. So I think tariffs were those instances.
It was a surprise, and surprise was putting it mildly because it had a lot of negative connotation to it. It was also, if we step back, last couple of years globally, we've had this phase where at the start of each year it looks like things are going to be tough. As the year progresses. Earlier it was the very high interest rates globally and a recession was inevitable, and that. And then this year was the tariff thing. Of course, as the year has gone by, it's not been as bad as feared. Frankly, I think there was a bit of an optimism within all of that this will get over sooner rather than later. As I said, the negative has been that it's just prolonged. But, so as a house or at a portfolio level, it becomes very, bottom up. There were no major top-down sectoral calls being taken. I must say that in any case, prior to this, at the start of the year, there was a sense that it's the domestic economy which should hold up, or do better relatively. There was always that uncertainty on the global front. But if I were to think of, other sort of changes at that stage, Yes, there were there were names, holdings in our portfolio. Some of them would have been bottom up in sectors which were hit or where there's great certainty, say some auto ancillary companies which were also exporting to US, and there's uncertainty of how much and to what extent they would have to take that the brunt of the tariff. There are some names, say in chemicals as well, where there was that element of US. Now as that period progressed from April onwards, it got a bit worse, because for India, as you know, in August the rates were revised upwards. So frankly, the first thing was to speak with our companies and get a sense of what are they saying. And surprisingly, or in a positive manner, they were very confident that, given their position in as a manufacturer of those or whatever they were supplying to the US markets, they were pretty much on a strong wicket. It wasn't as if their product was substitutable and that price was going to be the determining factor for the buyer to switch. That's the sense we clearly got at a 25% tariff level.
So when US election happened, Mr. Trump came in, talk of tariff, we all thought that India would benefit from that tariff. We would have a China plus one strategy, we would have a favorable tariff terms, and that is where India manufacturing hub would also, or as a country, would start growing on the manufacturing side also. But to our surprise, actually, when we said unpredictable to 25, is that we are the only country as we speak which has the highest tariff. US trade deal negotiation has been done with almost all the country, and as a country we are still hoping that trade will happen. So we were waiting it to happen in September, October, November, we are in December. So I think that uncertainty remains. In that period of time, I think government also realized that this may take time, and the focus on supporting domestic economy increased further.
And yeah, multiple sectors were affected by the tariffs. Now, some sectors, they felt it more than the others, and especially those heavily dependent on the exports to the US.
But there are two elements to it. Is that something that came out of the blue, you kind of try and assess first of all what is going to be impacted and how much is going to be impacted. For example, the initial headlines talked about 50% tariffs on India, but there were a lot of exemptions that were provided. For example, electronic goods are completely exempt from this retaliatory tariff that's there. So one has to study in deep what is actually happening and then take an assessment of what are the segments or sectors that are going to be impacted out of this. There are areas which are impacted, textile, gems and jewelry, which have a very significant export component, and particularly the US is a large customer of those markets. Our assessment at that point in time was that there are one of two scenarios that kind of play out. One is that the additional 25% tariff is a shorter term issue, which means that within say 6 to 12 months, India will have some form of a trade agreement with the US, and these tariffs will get kind of rolled back. And the second is a slightly more tougher scenario where things get dragged on for a 3-4 year time horizon, and therefore you try and do a bit of scenario analysis that which companies are going to be well suited to bear through that 3-4 year time horizon that's there, right? Like for example, if you think of textiles, right, it is a fairly labor intensive industry. We have a lot of competition, right, from Vietnam, Bangladesh, etc., and supply chains are also rooted in certain manner, right? So it's not going to be easy for domestic textile firms or apparel manufacturers to suddenly adjust to the business environments, right? And there is a risk that some of them could actually start losing a lot of money, which is kind of quite evident from the results that you start seeing now, that many are losing money on the US trade because you're having to discount your pricing and effectively bear the tariff itself. Some would probably be able to bear through it through innovative means, or also but just the sheer fact that India is a large supplier of those goods, right? And there is no other place in the world that actually provides those goods from, like to get polishing of diamonds, right? I mean, India is the center. 90% of diamonds get cut, polished in India. There isn't any other geography that can do it. So that industry probably will be able to withstand that pressure a lot better than, let's say, textile. So you take a bit of a dynamic call depending on where you are invested. Thankfully for us, we weren't invested very heavily on many of these impacted sectors, nor do I think was generally the market itself. So, which is why, we didn't have that big an impact on financial markets when those tariffs came through.
So look, I think that the very first few sectors which got impacted were, of course, gems and jewelry, textiles, because they were immediately impacted, and that kind of started reflecting. Even auto ancillary saw that impact coming in a little early than what we saw at a broader level. So these were the first few sectors which actually saw that impact. Then there was second layer impact in terms of ports, freights, and which will be a second in line because of obviously lesser exports in turn. So obviously those were the first few sectors, and then obviously there were a host of other, because we had noise around H1B visas and IT coming into that ambit at some point. Those rhetorics were there. Chemicals, pharmas, of course, we've seen a lot of to and fro, particularly on the pharma side. So there were multiple sectors, but I think the first in line were these. And in the listed space, the overall exposure to the market is not as high, particularly for, say, gems and jewelry and textiles. So that proportion was not very large, and it was reflected in the portfolios also to a larger extent.
So from a tariff perspective, there are two sectors which get impacted more, which is one is textile garment and the other is auto ancillary. Since in my fund we have slightly more exposure to auto ancillary, I'll give you a live example. One of our portfolio companies invested around COVID times. They commissioned the plant. They have invested a large sum of capital, more like 1100 crore, in a foundry unit in the US, and it's taken them 3 years plus to man the capacity. A simple thing like getting the right skilled people at the right place to just reach full utilization has taken them more than 3 years. They had to take special permission from the US government to bring Indians to train the people there, and it's not easy. So in fact, in this tariff environment, last 12 months have been quite challenging for some of the businesses. We've actually chosen to add our exposure to auto ancillaries. Wherever you have skill sets and technical capabilities which you don't find in the US. So it's different for different sectors. For example, garmenting, we know that things are very serious. Having said this, what the government has done is interesting actually, is that in the last, so what happened was in 2021, government put anti-dumping duty on man-made fiber, VSF and PT and all those things, and just after, so they had abolished those anti-dumping duty or import duty, for example. So we had an import duty structure, so inverse duty structure, so they had abolished that duty. But what the government did interestingly was at that time, they put QCO norms, which is quality control norms, which basically meant that whichever company was manufacturing those man-made fibers in India was selling at a significant premium, 30-35% at times, to imported price or to global competition. Just this week or last week, government has abolished QCO norms as well. So this tariff impact, for example, one, the rupee is depreciated from 83, 84 to now 91 as we speak today. And you have QCO norms being abolished. I would say that certainly I'm more hopeful now. So you don't need tariffs to help you so much, to tariffs to come down actually. It's the government, your own internal efficiencies you should take care of, which is what is happening. So I am more hopeful even on garmenting and textile companies these days. So it's not such a bad thing for India actually. We are anyways very small. We are only going to gain market share, that's it.
If you look at it in terms of impact, then this impacts a lot of companies which are in commodity type of businesses, and most of them are small and unlisted space. So hasn't really impacted the listed space from the market perspective much. In terms of earnings also, there is not much impact. So to that extent, I think it hasn't yet impacted listed space much. I mean, no doubt the 25% going to 50% and the, I mean, lot of commentary which was coming from US, I mean, it had lot of, I would say, a lot of noise value. But in reality, the impact on companies' performance, yes, it created lot of uncertainty and it still remains there. But as I said, that most of the companies which were likely to get impacted, they were in unlisted space and relatively smaller companies. So on a very objective analysis, it was felt that we don't need to react to it, and in any case, this number is likely to be a temporary number. So we'll see, how it eventually plays out. So in that sense, there was no major change in approach. Apart from that, it created a lot of news value, lot of noise around. Yeah.
Even now, companies and policymakers are still finding ways to navigate around these tariffs. But the pressure didn't stop with the traditional export sectors. Tariff also hit one of our hero sectors, IT, information technology. And it wasn't just the tariffs. Trump also proposed a $100,000 fee on H-1B visas, a move that directly affected Indian IT companies. And all of this came at a time when there was already softening demand in IT, not just in India, but globally.
Look, there was clearly a reaction to the rhetorics that was going on, and as you pointed out, there was already weakness in the sector in terms of how the sector was performing. So those things were of course there, but was there a reaction from my end? Clearly no, because when I was looking at the sector, two things were very clear. One is that we were in a trough phase as far as the growth rates were concerned. FY26 would be the third year where the sector is growing at just 1 to 2% range. And what this had led to was that the valuations of course had come off meaningfully. So we were actually looking at valuations much lower than what the recent 5-year average would be. So both these things actually pointed out to probably an opportunity sitting there at some point whenever things start getting back to track. So as I said, fiscal 24, 25 and 26 are ended up to be single digit growth years. What happened actually was that fiscal 24 and 25 were almost, fiscal 24 had passed and fiscal 25 looked like that, it was a pivot or a turning point, because the Fed had started cutting rates by September. And the expectation was that the discretionary spending, which was not there at that point in time, would kind of make its way back. And that's why the sector actually started doing very well. If you look at the calendar year last year around this time frame, or rather say September, November time frame, the sector actually started doing very well, because there was expectation that this 2% growth rate will probably go up to maybe 7-8% or so. And that's why the sector started doing well. But then we had this worry of, tariff and concerns were already there to some extent. Over and above that, you had a Gen AI-led wave also, which kind of started picking pace even higher, even more. So all of that kind of led to what we saw in the sector, and it corrected sharply.
So the IT sector started underperforming much earlier, right? Somewhere in the latter half of the last calendar year. And the reason for that was a slowdown in terms of the growth, which was growing at earlier around, say, in the high single digits, 9%. That growth rate came down to low single digits. And concerns about US market, because if you look at a year back, there was a concern about US growth, right, because of high inflation and other factors. And discretionary spends came down. So IT sector started underperforming much earlier, and the valuations kind of trended down. During the tariff war, I think there was concern about whether there will be restrictions, on Indian IT on the visa front. I think one thing I think in our mind we were clear that while the tariffs are on the trade side, on the services side, I think US can't do without India, right? And in the services, while we export a lot, but also there are a lot of services imports, which we do, right, from companies like Global or Meta. So I think our view was that the Trump administration, they would not do anything to the IT services in terms of imposing higher tariffs. The tariffs were there mainly on the trade side. Some restrictions on visa and this thing which was expected. So in a sense, that fall which happened during that period was an opportunity, because the sector was already underperforming. The valuations were reasonable, and I think overall for the IT sector, our view, we actually turned positive.
So if you look at from the beginning, IT sector had started to slow down, or it was only largely because the US economy was slowing down. See, when Trump took over, US had the largest fiscal deficit, maybe close to 6.5 or 6.7%. At that fiscal deficit, it was very difficult for the US economy to keep expanding. Market thought either they will cut increased taxes or they will have more tariffs so that they can bring in more revenue. And given that uncertainty, even the US corporate doesn't want to invest in US, doesn't want to start on discretionary spending, and that has an impact on Indian IT services. And which is why the Indian IT services started the year itself on a slowing note, and then the tariff and all that impacted it further.
So, we have been maintaining negative view on Indian IT services since last 2.5 years or so. And our thesis over there was that the uptick in growth which we saw after COVID, that was not sustainable, whereas valuations had also moved ahead significantly. So our expectation was that as we move ahead, the growth rates will more mean revert to where these companies used to grow pre-COVID. And if that were to happen, then valuations were definitely on the higher side. So that was the predominant reason because of which we were maintaining underweight stance on Indian IT services. AI and the narratives around AI, that how they can have an impact on Indian IT services business, that led to this growth challenges being talked about more openly. And I think that's where the sentiments around IT stocks worsened and we saw correction happening there. So it is more to do with IT sector's own dynamics than the tariff narrative.
Then the other sector which was hurt was of course IT. In terms of the sentiment, if you recollect at the start of the year, towards the end of last year, IT was looking up. It was it was coming out from a phase of prior 2 years of very lackluster growth because of this whole uncertainty on US growth, recession and all of that. As I said, all that has surprised positively. So ideally this sector should have really done even better as the year progressed. But then this clearly threw a spanner in the works, so to say. Now there again, it's not like we got, took calls to go reduce weights. And of course, it also varies. There would have been, in fact, in the funds I managed, some cases where I'd already, I was lower weights by the start because valuations were rich at that time. And then, in fact, this was an opportunity, so to say. And in some other cases where on a bottom up, had some large or weights which I was comfortable with, I did not tinker with that.
The impact that showed up clearly in investor behavior. By September 2025, FIs, foreign investors, had sold nearly 67,800 crore rupees worth of Indian IT stocks. That's the highest outflow amongst all the sectors. Though Indian IT stocks fell this year, there was also something interesting that happened. The NYSE FANG, which consists of top US tech companies, that went up. What's happening? Well, you see, these companies are heavily invested in AI while the Indian IT companies weren't positioned in that exact same way. Our strength had always been execution and scale, not owning AI platforms.
Indian IT are anti-AI, the way the market is looking at it, right? AI companies are companies, which are benefiting from the AI boom, the investments, which are likely to be in that sector. It's a high growth expected to be, where IT companies are more slow growth, steady growth, good cash flow companies. AI companies require a huge capex, right, initially. So the initial returns will be low. Indian IT companies are generating good cash flows. So I think market in a way was driving growth. It was more growth oriented and chasing these growth stocks. And Indian IT companies were more like a dividend yield stock, low growth kind of a story. And that led to the divergence, what we saw between the AI led and the Indian IT stocks, which was there. One is that AI is here to stay, right? It's not like a fad. There are genuine benefits because of artificial intelligence which you can use for productivity improvement, and it will evolve over a period of time. I mean, .com was a one-off event, right, when you're moving from one millennium to the another. Secondly is that the companies, if you look at the large companies, they are pretty cash rich, right? So their balance sheets are in good shape. So we are not going to, like in the .com, there was a big investments happening there at that point in data cable company, right, which were highly levered. And when the bust happened, we saw them getting bankrupt. So that's not the case at this point in time. A lot of these large IT companies, they are well funded. They have got enough cash. So I would say that there is a euphoria, which is that there is exuberance. People are factoring too much into the future earnings at this point in time. As AI catches up, especially enterprise adoption and actual real use case of either revenue model comes in, I think you will see some of these companies again starting to move up. So it's more about valuation rather than being an absolute bubble and a meltdown.
We are on the other side of the AI debate, right? So there's been very few, some small names here or there, which have really participated or rallied on account of being part of the whole AI thematic. So in fact, I would think India will be a good hedge actually versus that whole cohort which is having a nice time right now. So yeah, I mean, I won't be too concerned except for the fact that there will be volatility in equities as an asset class. I mean, there could be wealth effect for not playing out because there's a fair amount of US investors' money, and a lot of it also across the world, some of it rather, if not lots, of sovereign funds is also concentrated in some of those top 7-10 names. There can be, if there was a major correction, there can be some impact through that loop. But again, I think Indian investors and the markets are by and large kind of immune from that.
I think very difficult to conclude that we are necessarily in a bubble as far as AI stocks are concerned. So essentially we are talking about Nvidia, Microsoft, Google and Meta. No doubt right now expectations are running very high. We have seen huge investment announcements around AI running into almost close to $1 trillion or so. Whether these expectations in terms of usage of this infrastructure which is getting created will turn into a reality or not, only time will tell. Whether it will convert into tangible cash flows or not, only time will tell. But I think this is a space which we need to watch out very closely. No doubt AI is very disruptive technology. It has potential to generate a lot of productivity in the way we do a lot of stuff, and that can have implications. But whether we are in a bubble zone or not, it's very difficult to say as of now.
Look, every technology wave will mean that you will have to let go of some part of the revenue, some legacy revenue, because the industry is evolving and you will have to move with that. So clearly there is always going to be a risk of existing business which will kind of get impacted and it will kind of deplete. But at the same time, there is always a requirement for an additional new layer of work which kind of emerges. Think of 2015, right, when you had this digital and SMAC kind of wave which was going, and worry on Indian IT was very similar. Probably the extent of worry is even higher this time, but there was a worry even in those years. At that point of time, if you think of any large company, and one large Indian IT services companies actually started calling out digital and non-digital revenue separately. Of the $10 billion odd revenue that the company had, closer to about $2 odd billion was coming from digital, and the remaining 8 was non-digital, which was likely to get impacted. Cut back to fiscal 23, which is the year when they stopped giving that breakup. Fiscal 23, the digital revenue itself had become closer to about $10 to $11 billion, and the non-digital piece had depleted to about $6.5-7 odd billion. So the new wave which came obviously got along that $10-11 billion worth of revenue. Obviously there was a depletion in the older one, but it still stabilized at some point of time. So I believe that something similar might unfold here. In fact, companies, global companies, and even one of our large IT companies has started calling out Gen AI-led revenue separately. So I see that most likely it will unfold in a very similar way. Yes, the extent of depletion might be slightly higher this time around, but eventually a new revenue stream will emerge.
So currently the two leaders in this technology are US and China. So they have a basic infrastructure model there. They have enough of an energy or energy policies in place, data centers in place, talent in place, everything is there. Now, from an India perspective, what is going to happen is that how do we harness this technology in our services as well as manufacturing sector is the key question. And my sense over here is that we will be deploying these technologies very, very efficiently, even if there is over investment, just like .com boom in US or in China. That over investment is not going to impact us in longer term. In fact, we will be benefiting from it in a big way.
My takeaway there is that stock prices have moved exactly in line with earnings. So actually what has happened in the last 12-24 months is that companies have surprised the market on earnings delivery, and the stock prices have kept pace with earnings delivery. So it's not as if that valuations have gone haywire or gone, there is no, I don't see a disconnect in valuations still as of now. Having said this, what is one takeaway that I do get is that I was listening to, for example, Louis Gave from Gave Kyle, and he made an interesting point is that globally, if you add all advertisement, online, offline advertisement globally annually, that number is something like $2 trillion. Whereas in the US alone, they are saying that data center capex was $400 billion last year, 600 this year, in 2026 600, and will probably be 1 trillion or more in 2030 on an annual basis. So if the total revenue pool is only $2 trillion, then how do you justify the amount of capex that the US alone is making in that capacity? So which is where the debate is that are they doing too much? But there is another argument that I hear is that in this technology or in this, let's say when you go to AI world, the winner takes all is the current argument that I hear from the players who are pushing for it. And hence the urge for very large capex, and whoever wins will take it all. Let's see, time will tell, but as of now, stock price perspective, I don't see too much into it, but there will be corrections for sure, but it's okay, I think.
While global investors were focused on tariffs and AI, something else was quietly changing back home. RBI cut the interest rate for the first time since 2020.
So reducing rate is also a way of passing on the benefit. So today, if you look at banking system as a whole, 1.8 trillion of loan book, approximately 50% of that is linked to the repo rate or to the external benchmark. So a 125 or 100 basis repo rate cut means lower borrowing cost for all for industry as well as retail. See, India loan book system has changed. So in the past, in the last cycle, 70% or 65% was corporate loan book, 35% was retail. Today it is exactly reverse. 75% is retail and SME, 30% is corporate. And within retail, the bulk of that is home loans. And that is linked to repo rate. So a reduced rate of interest, which means a lower housing rate, that would indirectly support the housing industry and also reduce the interest burden. Similarly, for SME, which are struggling with export, it's in a way help them to reduce the interest cost. So I think from a medium to long term perspective, a reduced rate is good for the economy. Second, it has biggest benefit for the markets. See, market we always look at equity market from a perspective of cost of equity. A reduced interest rate means cost of equity also goes down, and thus to an extent it helps more flows of money to the capital market.
So it was important for at a time for the economic growth underlying, as I said, the economic growth has been weak, and both in terms of consumption especially was weak, and the retail balance sheets were getting impacted. So the consumption, especially which is also dependent upon borrowing, right? A lot of households are now borrowing. The household balance sheets had become slightly stressed, and it was important for the monetary policy to support the growth, because on the fiscal side, the government is going in for a fiscal consolidation. So there is very little room for on the fiscal side for the government to do anything, and that's how the governor responded this year by cutting interest rates, and as a result of that, we've seen that initial impact was negative on the banks. It's a big beneficiary for the financial services sector. For the banks, initially it was negative because that puts pressure on the margin, right? Because when rate cut happens, your lending rates go down faster than your deposit cost goes down. But by and large, I think that should help to stimulate growth and consumption. Your EMIs go down, your discretionary income goes up, and that happens, you will see an improvement in the overall retail credit growth. Also, the retail household balance sheets, which were slightly stressed, this interest rate cut will help them to kind of delever a bit. So I would say that the rate cut is broad positive for the economy, it's positive for credit growth, and positive for rate sensitives companies, and that includes say banking and financials.
Repo rate, when we are thinking about repo rate, the primary decision making is Reserve Bank of India. So in 2016, through Parliament Act, Reserve Bank of India became an inflation targeting bank, which means inflation targeting central bank, which means the primary objective of Reserve Bank is to get inflation in the band of 2 to 6% with 4% as a target. This has been said by the Parliament, which in consultation with Reserve Bank and Parliament. So what happened in 2025 is that inflation started moving below 4% also, and there was space that has been opening up vis-a-vis inflation, and that's why we saw repo rate being lowered from 6.5% to current 5.25%. So remember here, inflation targeting means that it's not current inflation that gets targeted. You see 1 year, 6 month, 1 year, 2 year inflation, what RBI sees that how it pans out, and then they take decision. So currently RBI is comfortable that inflation will be around 4.5% as per their projections, and that's why they lowered the rates. You need to have some cushion above inflation, so that the purchasing power of your money remains stable given a basket of food and manufacturing products and services that you consume, basically a margin over inflation. Repo rate has some margin over inflation, forward inflation, and then you lower it. So primarily, yes, RBI is an inflation targeting bank, and depending on its forward-looking assessment, we saw the lowering of the repo rates. It was factored into the markets that we will see as inflation trajectory will go lower. Of course, this 0% was not factored into the market earlier in the year, but as a fund manager, broad direction, we knew that it's going to be a lower repo rate, and that's how we cyclically positioned ourselves for repo rates being lower.
And it wasn't just India. I mean, you had central banks across the world, US Fed, the RBI, Bank of England, ECB, Canada, Australia, and all the others that were beginning to shift in that same direction. But to understand why they were cutting the rates in 2025, you need to rewind a bit. Because a few years earlier, these same central banks, they'd done the opposite. They had aggressively raised interest rates. Why? You see, that's one way central banks used to reduce inflation. And if you remember, inflation was shooting through the roof in many countries, especially the Western ones. So they raised interest rates, and it appears that the method worked. Inflation rates world over were healthier in 2025. But interest rates alone don't revive an economy. What really matters is what happens on the ground. And in 2025, something important changed as well. The government stepped in with tax reforms, income tax cuts, and GST rate reductions. More money was left in the hand of consumers, and prices eased in key categories. And demand, it finally got some breathing room.
When you consider GST or any kind of taxation reform, it's a taxation reform by the government or long-term reform by the government. So from a portfolio perspective, there are short-term impact as well as there is long-term impact. So what are the variables that change because of taxation reforms? The first variable that changes is consumer price index or inflation rate, which RBI targets. So what we see over here is that when you pay a price of good, GST is added into it, and which gets as an input to the CPI. So we see a bit of lowering in CPI in the shorter term. That is one aspect to it. Second aspect to it is that government revenues. The government may forego a revenue in the shorter term which can impact interest rate markets in a bit, can add a bit of volatility. But overall, what happens over here is that then you position your portfolio for this impact, that structurally this helps in ease of doing business, as well as the base or this political or the structural financial economy base becomes more stable, and it helps in lowering the cost of capital or interest rates, and that's how you approach it, a bit of short-term volatility but a big benefit in the longer term.
Simply because if you think of the last prior to 2 years or so, there was definitely a sluggishness in consumption-led growth. So post-COVID, we saw that after the unlock, there was a bit of a pent-up demand, but then the government directed resources towards infrastructure and capex, and that part of the system was driving economic growth. Consumption had been very sluggish, and so it's thankfully governments tried to help this.
The economy has been growing. It's been kind of mending its way through because we've gone through a bit of a structural shift in the government's thought process as well, right? So the government was following a fairly sort of fiscally constrained policy for some time. They were cutting deficits. They wanted to consolidate the balance sheet of India. Wanted to cut down on interest expense as a percentage of overall government receipts. So all of the efforts were there to be more fiscally consolidating, and this year has been one where they started to make material changes. You had the income tax cuts announced in February, implemented from April onwards. You've had the GST tax cuts that have happened. So the government's gone a lot more fiscally expansionary. The RBI, which was more sort of tightening mode for a fairly couple of years, for almost about 2 odd years, has now gone on the path of being a bit more sort of from an easing standpoint, and we've seen rate cuts have happened. A lot of liquidity has been pumped into the system. So there is a fair bit of a change in both the fiscal and monetary conditions that are there, and that's started to sort of show back again from a demand perspective, and therefore growth has picked up, right? Investments in infra continue to happen. Just the fact that tax cuts have happened, more money in the hands of the consumer. GST cuts have happened, which means prices of goods are lowered. So you're starting to see early signs of a growth recovery that happened.
So no doubt these tax changes have an impact at the margin in terms of demand. When income tax rates go down, which means that more disposable income in the hands of people. When GST rates go down, which means that price correction in the eventual price of goods for the end customer. So both these things mean that that at the margin you have incremental money available to spend, and that should lead to pickup in demand in certain categories. But can we generalize that just by rate cut demand will go up permanently? I think it's too simplistic to conclude. But near term, yes, increase in disposable income is positive for consumption stocks in general. I mean consumption businesses in general. In terms of our own changes to portfolio, we are positive on consumer businesses in general. Within that, we are more positive on consumer discretionary, but that has been the view more because of the longer term drivers for consumer sector in India, and not so much dependent on the recent rate cuts which we have seen.
This wasn't about creating a consumption boom. It was about restoring confidence slowly. And with that problem tackled, central banks could focus on economic growth. And once you had stability entering the picture, you could see how investors started behaving differently. As in DIIs and FIIs, these are the domestic investors and foreign investors. You had foreign investors that stayed cautious, but domestic investors, they did not step away. They stayed put. They kept buying month after month.
So the way I think about it is that when we look at it from foreign investors' perspective, they have the choice between investing in developed markets or emerging markets. Within emerging markets, they have choice to invest in countries like India, China, Brazil, Russia, or Vietnam. So the competition within emerging markets is also there. So from a foreign investor's perspective who has mandate, let's say, to invest in emerging markets and he has these host of options available, he would evaluate it from the perspective of where the growth prospects are better, where valuations are favorable, where economic cycle is turning. I think all these factors eventually come into play whilst deciding about the allocation. And if he decides that he wants to go overweight on market X, he has to take that weight from market Y. And then the relative valuation comes into play, the relative growth opportunity comes into play, and based on that decisions are taken. Very true that in last few years we have seen that FIIs, they are generally selling in Indian markets, and we have seen markets like China and all, they have of late done well. But to my mind, it's largely a play of relative valuation. China had become too cheap. No doubt our valuations had also moved a bit ahead of fundamentals, and that is what is getting reflected in market performance as well. So I would not read too much into it. I think it is more a play of relative valuation than anything else.
I think a bigger element of the FIs looking to move out of India was more to do with just the base fundamentals, that valuations were expensive, earning growth was slowing, the economy was also slowing off, and there were a lot of other markets that were looking a lot more cheaper, and momentum was fairly in favor of those markets, be it China or be it Japan, or just going back into US tech, right? So from that standpoint, with slowing growth, slowing earnings, and valuations being expensive, was it surprising that the FIs are flowing money out of India into other markets? Not really. So I wouldn't peg it just on tariffs. I think it's a lot more broader, fundamental oriented at this point.
I think it's a mix of both. It's clearly an irritant maybe for some cohort of investors. Just this, because it's also uncertain how long this will continue. On the other hand, I think the year gone by, 2025, clearly there were other bigger factors at play, which determined the nature of flows we saw as we did, which is that India didn't see or saw outflows from FI money essentially right through the year, maybe a couple of months in the middle, but in last 2 months again it's been outflows in the secondary market at least, and whereas money was going into the China, of course, which at the starting point was at attractive valuations, but also then other markets in the Asian region where clearly there was that AI play, so can't deny that, and they were clear beneficiaries. There was nothing, at least at this point, assumed to be a beneficiary under that AI umbrella as far as India is concerned. Right or wrong, time will tell, but that's how that has played out. And also, having said that, if you think of the start of this calendar year 25, clearly valuations in India were on the higher side. And then as the year progressed, it's not like we had some very strong earnings, trajectory. Earnings was modest, at least, for the large cohort of companies. So all that, would have given reason for global investors to be thinking more positively towards other alternates.
So what investors should look at it is that, yes, our growth is one of the highest in the world, but we are one of the options to a lot of countries, and how our structural story is vis-a-vis currency, macroeconomic development, current account, how is our nominal growth going to be, whether currency is going to be volatile or not. So, currency volatility also forms part of, decision making. So what we saw that whenever currency is less volatile, we tend to get inflows. When currency is, a lot of volatility, investors don't prefer it. What we have to do or think about is, a broader set of factors which makes India attractive. And the most important takeaway is that, we are one of the options in a global portfolio, and we have to take that as an input factor.
So I think, of course, tariff was one of the reasons, I would say, but there are others too, right? I mean, if you look at our, EPS growth at a Nifty level, we were growing in double digits in 21, 22, 23, but then from fiscal 25 onwards, we've seen that number come down to single digits. Even fiscal 26 will be near about single to maybe just a tad bit into double digits. So clearly one was that we were sitting at a valuation which was obviously high because we've seen the markets do really well over the last few years. And the growth rates at a corporate level kind of started tapering off from a good mid-teens to low teens number to a single digit number. And over and above that, you had these rhetorics of tariffs and the impact eventually which will start flowing into numbers if this doesn't change sooner. So all of that kind of culminated to what we really saw. And FIIs obviously have multiple other options, multiple geographies where they will pivot to, and it's more of a relative call which I guess has led to what we see.
And this is important, right? That gap between foreign caution and domestic conviction became one of the defining features of 2025. And it also kind of explains why certain sectors quietly took the lead. You see, when investors want stability, they don't look for the next big disruption. They look for liquidity, balance sheets, earnings visibility, which is why banking and financials finally had their moment.
Yeah, so most of the banks that I meet nowadays are likely to deliver ROEs between 14 to 16% sustainably for the next 2 years, 3 years. And probably growth will pick up toward 15% or higher in terms of profit growth. And valuations are below normal. A typical recipe for re-rating for the whole sector. So I would say that 2025 probably was a trailer. 2026 and 27 could be far better.
I think we like this space, and why so? Because if we look at say last 2.5 years or so, there was some pressure building up on the unsecured retail side, but RBI acted on time, and I mean right now my sense is that that has already played out, and from here on that side we should see incrementally positive developments on asset quality. But in general, last few years, and this trend started pre-COVID and post-COVID, we have seen it has continued, that the asset quality for banking system, lenders in general, both banks as well as NBFCs, has remained on the healthier side. With the fiscal and monetary support coming in, growth should pick up, which means your credit growth going up, advances going up. With interest rates going down, as liabilities get repriced, margins should start improving going ahead. Credit costs should remain benign because asset quality, there are no concerns as of now. Most of these entities are very well capitalized, valuations are reasonable in the context of broader markets. So I think there are enough reasons to remain positive on this space, and that's why we remain constructive.
Last calendar year, and prior that, it was at a time when actually the profits were growing, right? Because in a rising rate environment, okay, they had actually see a margin expansion, and the valuations had become fairly attractive. Right, if you look at the banking sector, their price to book value P multiples were below the long-term averages, whereas the broader market last year was much higher. So it was, once in this calendar year, what we've seen in this year has been a change where the outperformers of the previous cycle, okay, not doing well, and the underperformers started to do well. So the banking sector was the one sector which had underperformed. The valuations had become attractive. It had also become under-owned. So a lot of FIS selling which happened last year was in the banking and financial services sector. So as a result, when the sector and more importantly the regulatory environment for the banking sector from the RBI side, which was very, very restrictive last year, with the new RBI governor coming in, we saw that starting to ease off. Some of the norms, the liquidity tightening which was there, starting to ease off. The loan to deposit ratio, okay, which had increased, also came down. So all, and risk weightages for bank also came down. So that was a real reason for the banking sector too, because the environment, the regulatory environment became more supportive, and that's why we saw the bank sector, right, even though earnings growth was not really that strong.
And after years of underperformance, financials started checking off all the right boxes. But not all money was looking for stability in equity. As uncertainty started piling up, tariffs, geopolitics, currency swings, and that AI-driven fear, some investors, they looked for stability elsewhere. And that's when gold and silver stepped right into the spotlight. And it's not because of inflation. I mean, inflation was actually cooling down at that point of time, but because confidence was rising.
The price rise of gold and silver, I think, are symptomatic of the fact that there is so much of uncertainty, particularly in the US. Some of the economic policies that the US is undertaking, like for example tariffs itself, would have, I mean, any other country doing what the US is doing today would have meant a large depreciation of their currency. Now, obviously, the US dollar is the world's reserve currency. It's very difficult to see that materially depreciate against a lot of other countries. And in fact, the heavy tariffs is meaning that countries are competing to try and depreciate their own currency. So, in that environment, the US dollar had probably only a few places against which it could materially depreciate, and gold and silver are or precious commodities, right? Be it gold, silver, platinum, etc., were sort of a clearer way for the currency to depreciate against, given the lack of opportunity and the uncertainty that's there. So, I think this whole overhang of what is going to happen in the US, central banks not also wanting to take a call on the US treasuries, fears of change in economic stance or capital controls, etc., which meant that money just gone into real hard assets of gold and silver.
Historically, US currency or dollar has been a base currency for export. Given what happened with Russia, Ukraine, and the fact that US has taken a lot of action in terms of currency, larger economies start feeling that they need to diversify or need to reduce their dependence on US dollar. Historically, US has been a very dominant force in the economy. Now China is another one which is emerging, and therefore there is always a thought process that we need to look at the other way. If US dollar dominance has to reduce, where it can. World over, China and all other economy has to invest in US treasury. If they don't have a trust on US dollar, they will start looking at investing other way. So, I think the biggest rally happened because of uncertainty with respect to US policy, second war, and third treasuries world over wanted to diversify, and that is why rather than the individual, even a treasury started buying gold. So, no one at the start of the year anticipated that gold would rally so much. I think if you look at last 3 year or last 4 year return, gold has given higher return than the equity markets.
Real assets started to feel like insurance in 2025. I mean, in a world where currencies are being actively managed, you have trade rules that are shifting every day with wars and conflicts, gold became a rescuer. Gold became a way to ride through all that uncertainty. I mean, silver followed, not immediately, but silver did follow, but sharply. But it was because of an entirely different set of reasons.
No doubt, last 1.5 years, gold has done pretty well. Both gold and silver have worked very well for investors. But the way to look at it is that gold is essentially, gold or silver, basically these precious metals should be seen as a hedge in one's portfolio. And the fact that they have done so well, that doesn't mean that you go disproportionately high on them. And depending on your comfort level, 10-12% of your portfolio one can allocate to these precious metals. But they should be seen only as a hedge to the portfolio, hedge to the risk of playing out or a major global dislocation happening in financial markets. That is when these commodities, they tend to do well. Yes, they have done well, but stick to your asset allocation.
Historically, gold and silver have had a sort of a bit of a close relationship in terms of the pricing structure. You can go back 40-50 years and see the ratio of gold price to silver price. Right? It kind of, there is a certain boundary condition under which it operates. There are extremes that happen, right, and which means that when on either extreme, then one will do better than the other. Now, gold had done very well over the last 3 years, right, and in fact silver had done almost nothing till about this year's meteoric rise that's happened. So from that standpoint, right, that silver had become extremely cheap compared to where gold was, and which is what led to this year's rally. That investors said that, look, if gold is where it is, then it's obvious that silver should also make a move, right? Because it is also a precious commodity. In fact, it has more industrial usage than gold has, and the price ratios are out of whack. So that's what played out this year.
And even in equities, you could see IPOs buzzing. I mean, despite all that uncertainty, right? I mean, tariffs, rate cuts, geopolitics, the IPO market didn't shut down. In fact, it stayed surprisingly active. And this was interesting because globally, the markets were cautious. And yet, here, back home in India, good companies still managed to come to the market and find a lot of buyers.
One is that you're seeing a fairly unique set of companies come to the market, right? So compared to what is existing in the listed universe, you've seen some fairly innovative companies come to the financial market. Sectors or segments that never existed earlier, right? For example, quick commerce or e-commerce companies. We've seen a whole lot of technology companies come to market. So, which is what has been a big positive, right? That, you know, a lot of these companies, which in the private space were doing fairly well for themselves, they've been growing very rapidly, they've been gaining a lot of market share. Consumers are all aware of it, and for them to come to the public markets, okay, that's an area where, you know, investors also would be invested. So, as one of my colleagues said, that, you know, the Nifty today represents a fairly old, tired set of companies. So, you know, they're not able to grow materially fast, right? Whereas a lot of these new age companies, the younger ones are coming in, you know, sniping at their heels, are growing a lot faster, and they're all coming for an IPO in this one. So, yeah, the IPOs have been successful because they are interesting companies, driven by fairly good guys with high growth prospects, taking on the incumbents, and yeah, in many cases, it's a great story and coming in at decent valuations.
So normally what we see is that when the secondary markets don't do well, the IPO activity comes down, right? And we saw that last year, right? In the second half, when the market started to correct, the IPOs activity came down, and it was there till the first half of this calendar year. And then when the markets bottomed out, we saw some IPO coming that caught up. So it's a bit surprising in that sense that when the secondary market is not doing as well, okay, so many IPOs which have hit the market in the last couple of quarters and large ticket IPOs, how come they have been absorbed so easily? So I think one differentiation which I see in some of the IPOs which have come in the past, these are companies which are slightly more differentiated companies. They're unique companies, and they're interesting companies, okay, which have a different business model, right, which is there. So the quality of the companies definitely has been much better. So that creates opportunity for, say, institutional investors to look at it. Because they offer opportunity to participate in these companies' growth, which you can't do it from the secondary market. So I think that was one of the reasons what we saw. Also, the retail investors have also kind of, sometimes it happens that they look at the IPO market for, again, quick returns, right? Though it's not always true. In fact, in the last 1 year, on an average, the IPO listings which have happened haven't generally given returns. But few IPOs give very strong returns, and at a time when the secondary market is not offering any kind of an upside, retail investors get looking at IPOs as an opportunity really to make quick returns. But the fact is that the companies which are coming into the IPO, the quality of companies or the businesses which are coming in have been fairly interesting and attractive. So for even institutional investors like us to look at some of these companies. Also, while valuations is one part of it, but we have seen the expectations on IPO people coming to the companies coming to the IPO market, they were very high a year back, right? That has also now kind of come down as the secondary market valuations have come down, and also that finding it interesting for investors, okay, to look at it, which was not the case a year back. And that's why we saw some lull period, okay, from mid of last year till first quarter of this calendar year.
That tells you something important. You see, investors weren't buying everything under the sun. They were buying specific stories, companies with visibility and a clear growth path.
So I think that one is that there is an appetite for newer set of businesses actually today in the investors community and even fund managers to a large extent. And you know, a lot of these businesses are actually pretty interesting. I would not say entire IPO, whatever we see in terms of, you know, getting listed, but quite a few businesses are new in many ways, and there is an appetite for that. That is one. Second is that, of course, because what we've seen in the markets in the last 3-4 years, there is, we've seen our SIP books go up significantly. We've seen that maturity at the investor level who is willing to park that money and, not bother about the near-term volatility. I think all of that is also kind of helping in many ways to evaluate these IPOs and look at them very closely. But this time around, as I said, the first point was inflection, that it's not that every IPO getting listed is giving you some very great returns. This time it's getting more balanced. It's more pause and reflect, where investors also realize that not everything under the sun is going to give you if it's coming for an IPO. So I think that there is a maturity in that sense as well, which I think is good, because then you'll have more quality names getting the kind of attention that they should, and not everything will be what we saw probably in the earlier years.
So it's a general trend actually, is that whenever valuations go higher, supply of paper catches up and it leads to valuations coming down. So we are seeing exactly the same trend right now, which is that in between 2023 and 24, as I was saying, valuations went up significantly for across market caps, and we are seeing, because of in line with that, initially it was the owners starting to sell their shares. That trend continues even now, but now we are also seeing new companies wanting to raise capital for their business. In fact, I can give you a lot of examples in the last 6 months, even some of them in my portfolios, where I am guiding we are trying to guide the management team that you can take some debt on the balance sheet, but the management team is saying, if I am getting capital at such a price, then I am better off taking equity. And so people are willing to dilute their stake given the valuation that, so which is what I am trying to say, is that whenever you have higher valuations, you are bound to see supply of paper increasing disproportionately. 2025 is one such example. I would say, given the valuation environment today, I would think that 2026 this trend will continue.
So in general, as a country, at least there is an equity cult which is coming up, and thanks to all the social media platform, to all the big retails, Zerodha, Grow, to an extent Angel, all broking. So if you look at any of the Telegraph channel, they started advertising investment opportunity. And in the past, when mutual fund used to operate, there was data arbitrage. Today that arbitrage is gone. Today simplicity has been the key word, which Grow has defined in terms of how to invest very easily. Second, when you look at India as a country, we are way ahead in financial landscape. In fact, we are way ahead of US also. Today you can open account, trade, invest at the click of the button. Everything, right from Jam Trinity, when we talk about it, has been a game changer for India. And I think it's you can do anything at the click of the button. Data is available at the click of the button, and that helps everyone to open more account, get more aware with the investment, and that cult has started. See, India has a very large population of middle class. As a middle class start getting a job and start earning, they will move from traditional form of investment, which is FD, bond or insurance. They will start looking at mutual fund.
I think it's human mind. You want to make quick buck, and a lot of people tend to look at IPOs like that, wherein whatever allocation you get, since generally listings happen at premium, you can make some quick buck. But I believe that that's not the right way to approach IPOs. We look at all these companies which are coming up for IPO on bottom-up basis. We take a view on their valuations, and if it makes sense, then only we participate in it. I think it's more to do with people trying to make quick buck, and that's what reflects.
Well, that's what these guys have to say about 2025. So what about 2026?
I think lessons for 2026, they remain the same. It's important to stick to your asset allocation. Number two, I think investing is always in an environment of uncertainty. So keeping your emotions in check goes a long way in long-term performance. So equity is a long-term asset class. Don't look at it as something to wherein you can make quick buck. You are essentially creating wealth by investing in businesses, and as these businesses scale up and they deliver value, as a shareholder you make money. So look at equities from a longer term point of view and don't chase the current fads.
I have a very, I am quite convinced on this, is that 26 and probably 27, concentration will work. So portfolio concentration is important because there is going to be a large divergence in earnings delivery for many companies. With valuations where they are, you need to pick and choose specific companies which can do well. So if you are a very diversified fund or if you have too many companies in your portfolio, I think time is probably right to think about or review your portfolio.
From a broader market perspective, I would say that I mean, for investors, India is not the only market, right, for investors. We saw in this period was other markets did much better than India. And this was a period where we saw a stark underperformance of India vis-a-vis most of the other large global markets. And that is, I think, one clear thing. So for domestic investors also, I think there is an opportunity to look at outside India as an asset allocation, right? Provided there is a room to do that. I think so that diversification, I think, is important. But we've seen that asset allocation is important. We saw precious metals like gold and silver gave humongous returns, right? So if you had maintained a right asset allocation in your portfolio, you'll be able to capture that upside. So I think it re-emphasizes that just over concentration into an asset class, just looking at past returns, right, is not the right strategy. This year there has been a change in leadership. So sectors which were doing well earlier, so it's not important to really chase the sectors which have done well in the past. We should also look at sectors which have underperformed. And this year we saw sector which underperformed last year, like banking and financials, for example, metals for that matter, they have rebounded. So it makes sense to sometimes go counter-cyclical and not just chase the past winners, because
From a markets perspective, my sense over here is that you have to look at everything from two aspects. What is the directional aspect of markets, be it asset class, be it country, be it any sector. The second aspect is what are the cyclical aspects of it, and how does that direction gets translated into cyclical aspect, or cyclical aspect gets translated into direction. What do I mean by that? So from let's say 2010-16, a direction was set that there was some sense that multipolar world is coming to the fore, it may come mainstream and all that. The direction was broadly set, but cyclically it was not there in the minds of the people. So last couple of years, that inflection point really made you think that this direction aspect and the cyclical aspect needs to take into consideration in this regime change. What we are seeing, that we will see maybe a volatile spike, some bit of those measures may be rolled back again, those measures will be can be reinstated. That is one thing, cyclical and directional. Second aspect is over that in last 40 years we have seen dominance of central banks. Governments were non-interfering in financial markets. Only central banks used to interfere in financial markets. What we have seen in past 3 to 4 years, especially post-COVID crisis and 2025, is that governments are now playing a very, very active role in financial decision making. We are seeing a discussion in United States about appointment of central bank head, Federal Reserve head, a lot of political as well as financial markets discussion. So the big learning from past 3-4 years has been that yes, now governments will play a dominant role in financial markets, unlike previous, let's say 30-40 years, wherein financial markets were left to their own vagaries or own operations.
I think three things that I would want to keep it on my radar. One is the continuity of the consumption boost which we've seen starting from the budget last year, and then in form of GST and the pay commission revision which will happen probably in 26 or maybe early 27. So it will keep the consumption led growth at the forefront. So that is obviously one which is going to be on my radar. Second is that if you look at the government capex, that kind of did really well in the last 10 years, particularly in the last 5 years. Now probably it looks like that it might, plateau, or not plateau, but grow at a very smaller pace than what we've seen in the last few years. So the idea would be to keep a close watch on that, as to how that kind of unfolds. And third would be the private capex, because that's something which has been lagging, and the expectations are that finally now that's kind of going to tag along and ensure that the macros look up as we want it to. So I think these three things would be clearly at the forefront. I would want it to be a very good year, but ultimately, as I said, if you look at the valuations, okay, just let's look at the core and the facts rather than doing a gut feel here. If you look at the valuations, because India has underperformed massively in this calendar year, the relative valuations are very much in our favor. If you look at whether it be emerging markets to us or even the broader global markets to us, this year, because we've not done anything in terms of returns, etc., as a calendar year, it's actually got us into a very good spot. That is one. Second is that the way our inflation numbers are and the way our GDP numbers are unfolding, India will still stand out in terms of where our growth rates are going to look like on a relative basis. So I think that this year should look very good, and as I said that we will be probably getting back to a double-digit growth in terms of Nifty EPS. So all of these ingredients are very much in place for 26 to be a good year.
The things I would be looking out for next year is actually multifold. And why I say that is because we are coming from a phase where there has been a lackluster growth in corporate earnings in India. And on top of that, this uncertainty of tariffs on a couple of sectors I mentioned, right from IT, auto, chemicals and all that. So there are a lot of these sectors where things have been sluggish, where the chances are that things get resolved more favorably than otherwise, at least as things stand today. So across domestic sectors, we know there has been enough or reasonable policy, support, both on fiscal, on monetary, then other reforms on labor and all of that have been underway. Similarly, on the tariffs, a lot of things have been sorted with other countries. Maybe it's India's turn. I don't know in how many months, but hopefully somewhere through next year. So when I look at it more bottom up, there's a lot to be looking for in next year.
So I think most important at this moment of time, where the focus of the market are on the trade deal and the contours of that, what will happen. That will give a lot of clarity not only for FY26, for a little medium term, even for a next 2-3 year perspective, where India would be. Second, a little more clarity on AI. See, today when we look at IT companies or IT sector as such, world over, anyone linked to AI has rallied very sharply. And so India is a non-AI trade. In that context, we are suffering to an extent. If AI investment were to slow down, or if AI is a bubble, or if when find that the AI would take a little more time and it would have some benefit to an Indian IT company, you could see IT as a theme should also do very well. So right now when we speak, there are two themes which are very contra themes. One is IT, second is consumption staples themes. Whatever government has done on GST, all that has benefited auto sector disproportionately, but I think the benefit of that on consumption or in terms of demand for staples is yet to be seen.
I think for 2026, I think the retail investors should look out for broadly 2026 being a continuation of what happened in 2025, a year of consolidation, at least for the first 6 odd months that's there. Economic uncertainty on the US remains. There is potentially going to be a change in the US Federal Reserve chairman. We don't know who the new person is and what policies that new person will actually bring about. We don't know what are going to be the economic policies of China heading into next year. So there is still a fair bit of cloud on the global economic environment that's there. In India, while I would have loved for small caps and mid caps to see a material price correction, but more than a price correction, it's been more of a time correction. They're still not very cheap, but therefore I think large and mid caps could do better. The silver lining in all of this is that our economic growth is on a mending path. It's more on an improvement path that's there. So I would not be not invested. I would think that this is a year where you stagger your investments out. Maybe spread it out over a 6 to 12-month period. Do an STP, but be careful of themes or thematic stuff which is flying very high. Like we've had railways and defense, which are crazy themes about 2 years back, and everybody made a lot of money about it, but it's peaked out in many ways. Valuations are very, very expensive in some of those themes. So be careful of themes, be wary of themes, be invested in broader markets, stay invested. Don't let the volatility worry you. Take advantage of the volatility.
Well, if there's a lesson that we can learn from the past years, it's this. It's nearly impossible to predict what 2026 will look like. Every time something big has happened in a year, it's been a surprise. And this year too is like no other. Well, for sure we can expect some themes to continue for at least a little longer. Tariff and trade wars, yes. Geopolitical factors, certainly, though we don't know how, but geopolitics is always there. Interest rates and inflation rates and GDP will change, as they always do. And as for the others, we'll have to see. Now, many of these themes will probably continue. Some will evolve. We'll see some new themes being born as well. We can't predict what will happen, but what we can do is prepare for the good and the bad times. We hope that this one will be a great year for all of us. Happy New Year and happy investing. Stay smart.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.